I want to talk to you today about investing in real estate. I think it's something that even if you're not doing, you've probably thought about, and I get asked about it quite often. So, there are several advantages to investing in real estate. Obviously, there are a lot of options as to where to put your money. And specifically to real estate, I'll talk about some of the advantages. So, first of all, it's a cash flowing investment. Very straightforward. The property is tenant occupied, you have a lease, you collect rent every month. It's a cash flowing investment. Number two, there are tax advantages specific to real estate that make it stand out compared to other options. Now, you should consult your tax advisor about tax advantages, but it's a reason that people invest in real estate specifically. Number three, price appreciation. So real estate is generally seen as a safe investment, but also with a lot of upside. So if you're going to own the property for, let's say, a 10-year holding period, hopefully you paid $150,000 for that building today. 10 years from now, hopefully it's worth $250,000 or $300,000. You get a double in value over a 10-year term. That's a very attractive investment. I want to talk about what you need to be thinking about when investing in real estate. So first, I think a lot of people understand there are varying property types. You have office buildings, you have apartment buildings, a retail center, a self-storage complex. There's varying types of properties and all could be good investments for you. However, a lot of people don't understand their varying lease types. So let's talk about a apartment building. If I own an apartment building and I rent to you one of my apartment units, in our market, we would typically do an initial 1-year term, and at the end of that 1-year term, maybe it renews on a month-to-month basis. If we have a retail building, let's say a Dollar General store, those commercial leases are typically much longer term. If a new Dollar General store is built in your market, I'm going to guess that initial lease term is 15 or 20 years, and it probably also includes several 3 to 5 year renewal options. So there are advantages to both types of leases. A short-term lease provides a landlord flexibility. So if you have a bad tenant, you can get out of that lease, or if prices fluctuate and appreciate, you can release or increase your rent to market. Conversely, the long-term Dollar General store lease has its advantages as well. You're locked in to a national grade retail tenant. You don't have to worry about them making payments. They are very well qualified and highly rated. And also, there's no turnover to worry about. So there are advantages to the security of a long-term lease. When we think about any type of investment, we want to think about our returns and our yields. So in real estate, a higher return property is typically going to reflect more risk. Let's think about a downtown mixed use property in a secondary market. So it's not necessarily a thriving downtown area. The building is 100 years old. So your first floor retail tenant, let's say it's a pizza shop, the apartments up above are certainly not luxury apartment units. So we have mom and pop tenants. We're going to have higher turnover, even with the apartment tenants. Likely more headaches, more management involved, certainly more turnover. There's upside there. You can increase rents. You can probably get the building at a lower price. You can invest in the building, upgrade the units, and perhaps get higher rents. But there's also more management and more landlord obligations. The returns on the retail store, on the Dollar General store, they're going to be lower. However, this is generally seen as a passive landlord investment. So it's a triple net lease. Again, it's a national grade tenant. The tenant is paying not only rent, but their utilities, taxes, building insurance, repairs, maintenance of the mechanicals. Really all the landlord has to do is sit back and collect rent every month. So that is, although the lower yield with that investment property, it's attractive to a lot of people who don't have the time to go and do repairs and maintenance to a building on a Saturday afternoon. When thinking about any type of property we're going to buy, we need to think about the long-term components and the capital repair items. If you're going to own the building for 10 years, is the roof going to need replaced? Is the HVAC going to need replaced? How about the mechanicals? What condition are they in? And we need to think about replacement and budgeting for replacement over the holding period. Lastly, I want to talk about financing requirements. So it's not your primary residence, so you're probably looking at least a 20% down payment and a loan term over 15 to 20 years. Interest rates fluctuate. Right now, they're a little bit higher. However, really, for our first investment property, we want it to, we're essentially looking for it to break even every month. We want our monthly rent, our cash flow to cover not only our debt service, but any landlord expenses and obligations. I think a good strategy is let's aggressively pay down the mortgage on that property in, let's say, 10, 12, 15 years. We're not really looking to make a lot of money initially, but we pay it off quickly, then we own the property outright. So then we're really doing well. We're getting our monthly cash flow, we have no debt service, we've got price appreciation, and now we can think about either selling that property and going from a 4-unit apartment building to an 8-unit, or using the equity in that building for a down payment on our next property. And that's really how it starts to snowball, and you can become a seasoned investor in real estate. Good luck out there.